This is our estate planning and business succession team up here. I'm Lauren Detzel. This is Brian Malik and David Akins and Matt Ahern. And we also have out here somewhere Kyle Griffin, who is in our department back there. Thank you for coming too, Kyle. And so we wanted to talk for the next hour about changes in the estate planning arena. And we're going to start it off. Brian and David are going to talk about income tax changes that affect estates and trusts and our planning. And then Matt and I are going to talk about planning under the new act. I'm going to talk about planning at death, and Matt's going to talk about planning during lifetime. So, and then at the end, if there are some questions, we don't mind staying over and answering questions. And let me say up front, we have some fairly lengthy PowerPoints here, and they're going to be sent out I think towards the end of the week or in a week. We're going to send everybody out electronically our materials in case they wanted to have them electronically, and we're going to include the PowerPoints. So with that, I'm going to turn it over to Brian, who's going to start. He's going to give us a summary of the act that affects estate planning.
Thank you, Lauren. So to start off, I've created this handy chart to basically summarize where we were in 2017 under the tax rules, where we would have been in 2018 if the act was not passed, and where we are now with the act. So 2017, the top tax rate for estate, gift, and generation skipping transfers was essentially a flat 40%. As you can see, that has not changed under the act, and it was not scheduled to change. The big change from the act gets into the estate and gift and GST, which refers to generation skipping transfer, tax exemptions, and that's the amount that an individual can give away free of estate tax, free of a gift tax during their life or at death for the benefit of anyone. Under prior law, the basic exclusion amount was $5 million, and that was adjusted for inflation every year after 2011. The inflation adjustments were based on the standard consumer price index. That's the big change now under the new act, is that that basic exclusion amount has doubled from $5 million to $10 million, adjusted for inflation going back to 2011. They've also changed the inflation adjustment table to now refer to the changed CPI index instead of the standard CPI. And essentially what that means is that the change CPI grows a little slower, so your exemptions are going to grow a little slower each year as well. And projections put this number at about $11.18 million per individual. We don't yet have the final release from the IRS, so we're just speculating at this point based on a lot of people who have done the calculations. Gift tax annual exclusion, it's also very popular. That's the amount that an individual can give away to any donee each year and not use up any of their transfer tax exemptions. That was $14,000 in 2017, scheduled to go up to in 2018 to $15,000. Under the new act, because of the change in the inflation tables, we don't yet have confirmation, but we believe it'll still be $15,000. Income tax rates for estates and trusts, the top rate was 39.6% under prior law. That was going to stay the same in 2018 until the act changed it. It is now 37%. And also miscellaneous itemized deductions under Section 67. Those are deductions for certain types of expenses that are paid by estates and trusts, the most notably of which is the investment advisory fees. Those are no longer deductible under the act, and David will get into what that means in a minute. And lastly on this chart I have uncertainties. So under the prior act, we had in law that the exemption was $5 million and going to increase each year by adjustments for inflation. Now, under the new act, we have this sunset concept where these increased exemptions only apply for 2018 through 2025. And in 2026, they revert back to the law in effect as of the end of 2017. So we call this the sunset. And I've seen projections out there that say if we do actually get to the sunset, then in 2026, the exemption will probably be around 6.75 million, but we won't know for sure because that's all dependent on inflation over the next 7 or 8 years. And overall, the uncertainty associated with the sunset brings up this concept of clawback. And what you're going to hear us talk about clawback, what we're referring to is, this is the question of whether the IRS is going to attempt to recover or claw back some of the gift tax benefits that an individual used during this limited window of time. So for example, individual has an $11.18 million exemption. They make a gift of that entire amount, and then they die in 2026 when the exemptions have reverted back to a lower amount. The question is, how is the IRS going to treat that, and are they going to attempt to recover any sort of tax that would have been due from the benefit of the additional exemption that they utilized during that time? We don't have clarity on that. We believe that was not intended by Congress, but we will have to see. Ultimately, Congress punted that issue in the new act. They basically said, IRS, you figure it out and let the public know what it is. So we may see some guidance on that this year. It may end up never coming to fruition. The IRS may punt the ball down the road a little bit, and maybe legislation will change that in the meantime. So throughout the rest of the program, you're going to be hearing about questions or concerns that come up because of these sunset rules. So keep this in mind as we go forward. So with that, I'm just going to turn it over to David to get right into the income tax changes of estates and trusts.
Thank you, Brian. Brian already touched on the changes in the brackets and rates for trusts. So essentially, income at all levels for estates and trusts is going to decrease. But the top bracket, you reach 37.5% at $12,500. So there's not a lot of play there. Brian also mentioned that this new Section 67G will suspend or disallow miscellaneous itemized deductions for taxpayers, individuals, and estates and trusts beginning for tax years beginning in 2018 through 2025. So, the question is for, tax return preparers, people, attorneys who represent fiduciaries and fiduciaries, what are these miscellaneous itemized deductions? First, it has to be an itemized deduction. So, you look at it and say, is this an itemized deduction? And if it's deductible in arriving at adjusted gross income, accountants would say an above-the-line deduction, then it is not an itemized deduction. So, that's the first step. But even if it's an itemized deduction, is it a miscellaneous itemized deduction, which is not going to be allowed in the years 2018 through 2025? And you have to look at Section 67B for that, and that gives you a list of things, and some of them which would impact the income taxation of estates and trusts generally would be interest, taxes, charitable contributions. But remember that even though these things may not be miscellaneous itemized deductions, so the deduction is not suspended or disallowed during this 9-year period, that there still may be other code sections that provide for limitations on their deduction, and Jane talked about some of those and touched on them when she discussed interest and interest deductions and taxes. The joint statement of the conference committee, which Steve Looney showed you a little excerpt from that, a little video excerpt, listed some specific things that they said, that our miscellaneous itemized deductions will not be deductible during this period of time. And the most significant of those for estates and trust is going to be, is that excess deductions allowed for a beneficiary on the termination of an estate and trust, which flowed out in the past, even though there were miscellaneous itemized deductions subject to a 2% floor, will not be deductible going forward. And tax preparation fees in general will not be deductible, but there are some exceptions for estates and trusts. Most people in here haven't prepared a fiduciary income tax return. How are estates and trusts taxed? Generally the same as an individual, but there are some unique aspects to determining the taxable income and the tax of estates and trusts. So they're computed generally in the same manner as an individual, but in arriving at adjusted gross income, they get deductions for costs of administration, which would not have been incurred had the property not been in an estate or trust. So these are expenses that are unique to the property being held by an estate or trust. They also get a deduction in lieu of the personal exemption, which was not repealed for estates and trusts, but those are only in the hundreds of dollars. And they get deductions for distributions. And the way estates and trusts are taxed, if an estate makes a distribution to a beneficiary, that carries out income, distributable net income, that's then reported by the beneficiary, and the trust or the estate receives an equivalent deduction. All of those things that are unique to estates and trusts are deductible in arriving at adjusted gross income, so they're not miscellaneous itemized deductions. But you have to look a little bit beyond that. Okay, I'm in the right place now. The Supreme Court told us in 2008 in the Knight case that administration expenses were not miscellaneous itemized deductions, only to the extent that they were not commonly or customarily incurred by individuals. I'm sorry about the double negative there, but in other words, they have to be unique to the fact the assets were held in an estate or trust. And the IRS, a few years later, was kind enough to come along and give us a reg that has some definitions of what commonly and customarily incurred by individuals means. And so some of the things that are unique to estates and trusts are costs of preparing estate and gift tax returns. That's an exception to the general rule that that tax return preparation fees are no longer deductible. Appraisal fees that you have to incur in order to file an estate tax return or prepare an estate inventory or to make distributions from the estate. Probate court fees and costs to file or to publish a notice of administration, notice to creditors when you have a probate administration, and the cost of fiduciary accountings. So that's going to be, how that's going to affect estates and trusts. I'd mentioned earlier about the impact it will have on beneficiaries. And if on the termination, the final year of an estate or trust, it has a net operating loss carryover or a capital loss carryover or deductions in excess of its income, then under prior law, the benefit of those loss carry-forwards or excess deductions passed out were deductible by the beneficiaries as miscellaneous itemized deductions. Are these things still deductible? It's not absolutely clear on this as some of the things that the tax department people talked about earlier. Because of the general statement that was made by the conference committee in referencing this, but it talked about deductions and administration expenses and didn't really address the loss carry-forwards. So I believe that the correct answer is that these carryovers, NOL carryovers, capital loss carryovers, will continue to be deductible because they really are offsets to income or deductions that are taken in arriving at total income before you even get to adjusted gross income. So I think that they are allowable in arriving at adjusted gross income. And if you look at the way an estate, they flow into an income tax return, that's true. Excess deductions, I think the answer on that is no. Clearly, that's what that's clear that that's what the conference committee was talking about when they talked about those being disallowed under the new law. There's some planning considerations. If you're a fiduciary and you're in the final year of an estate or trust, you may want to think about if you have an expense that has to be paid in respect to an asset, do you pay it before you distribute the asset to an individual or to a trust, or do you distribute it before and let the trust take that deduction if the estate would not have any benefit from it because the total of all your deductions are going to exceed your income. Now, putting off the payment of that until you distribute it to a beneficiary could affect the interests of the beneficiaries, so you might have to make an equitable adjustment, but that may be preferable to just losing the benefit of the deduction at all. And keep in mind, if you're doing advanced planning and you're doing a decanting, If you're decanting all of the assets from one trust into a second trust that's a separate taxpayer, say because it was funded by a different settlor, a different grantor, then that's going to be treated as a distribution and a termination of the first trust. So you could get caught with this in this non-deductible excess deduction scenario, even in a decanting. If you're a fiduciary, like an attorney or an accountant or a financial advisor who is rendering advice to fiduciaries, you probably ought to bill separately for your work for an estate and a continuing trust, like a revocable trust that the estate's going to pour over into, or an administrative trust that's going to split up into multiple trusts in the future. And think about where is the appropriate place to bill your time and which is the appropriate entity to bill to try to avoid this excess deduction problem. How am I doing on time? Okay, I'm going to skip the the $10,000 aggregate deduction for state and local taxes applies to estate and trusts. You may want to look at considering creating multiple trusts. There's not a whole lot of play there because of the low thresholds, the low taxable, the $12,500 top bracket. The last thing I want to touch on are the changes were made to electing small business trusts. SBITs are a type of trust that would not otherwise qualify as a shareholder of an S corporation, and so they elect to qualify, but in exchange for that, they agree to be taxed at the top corporate rate, which we were told earlier that'll now be 21% unless amended. And now a non-resident alien, or an NRA, can be a beneficiary of an SBIT that is which by definition is an S shareholder. Now, the NRA can't be a direct shareholder of the S corporation without terminating the election, but can be a beneficiary of the SBIT. The other change with respect to SBITs is that the charitable deduction for them will now be computed not under the general charitable deduction provisions for trusts and estates, but under the same provisions as for individuals. And that's got some benefits because it means that they won't be limited to, the deduction won't be limited to gross income as it is now, which was just confirmed in the Green case out of the 10th Circuit this year. And the charitable contribution doesn't have to be made pursuant to the terms of the governing instrument of the trust. And the IRS has been consistent in holding that they will not recognize a modification of a trust that allows charitable deductions. Hopefully I didn't impinge on Brian's time too badly.
It's not my time, it's all Matt's time at the end. All right, so thank you, David. For those of you in the estate planning world, you may notice that there are some hot topics in our arena that were not included as part of the act. First and foremost is estate and gift tax repeal. This was in the House version of the bill. It did not make it in the Senate version of the bill, and it did not make it out of the conference committee. I'll leave it up to you to figure out whether you think estate tax repeal is a realistic prospect. We did have a Republican in the House. Our Republicans control the House, the Senate, and the presidency. It's been on Trump's wish list since he got in there. It's been on the Republicans' wish list for decades, but they still did not get it done. Second of all, there's nothing about valuation discounts. And for those of you that deal with closely held businesses, you know that a lot of times for transfer tax purposes, individuals will gift away minority interests in entities, and instead of taking the pro rata value of that business interest for gift tax purposes or whatever it may be, they claim discounts for lack of marketability or lack of control. These regulations were proposed in August of 2016 when the Republicans prevailed in the election. These regulations essentially were dead. They were formally withdrawn last year, and we don't expect anything to come up again under the current administration. So that's probably why I didn't see anything in that. Matt's also going to talk about some dynasty trust planning and grantor trust planning. Under Obama administration, there were two proposals. One was to limit the length of that assets in a trust could avoid some sort of transfer tax to 90 years. That is not included in this act. So dynasty trusts are alive and well. The other proposal was to include assets of a grantor trust and the grantor's gross estate when he or she passed away. Grantor trust is basically I give assets to a trust. I retain certain strings that cause the income tax on the trust income to be my liability. So essentially that inflates the value of the trust assets for the benefit of the beneficiary and decreases the grantor's taxable estate. That provision trying to include those assets was not included in the act as well. So with that summary of the act provisions, we're now going to talk about how do you apply them. And what you should be doing now, I have 5 up here on this list of ways that you can go back to your office or wherever it may be and implement these 5 things and potentially save your clients some tax dollars immediately. First one we're going to talk about is reviewing formula clauses in wills and trusts. And this one is a big one. If you've ever seen a will or a trust that contains some tax planning, you'll often see a formula clause in there that says something to the effect of, I give the maximum amount that can pass free of estate tax to a credit shelter trust for the benefit of the spouse and maybe descendants as well, and then the remaining balance goes to a marital trust for the sole benefit of the surviving spouse. Well, you need to go back and look at that to see if that's still consistent with the settlor's intent, because essentially the gift to the credit shelter trust just went up by about $5.6 million because of the act, which could cannibalize most of the marital trust or even all of it. The other thing you'll see sometimes is a formula clause that says I give the remaining available GST exemption to my grandchildren, or a trust for the benefit of my grandchildren, with the balance to the trust for the benefit of children. Well, if that's the case, the children's inheritance just went down by $5.6 million, which they're clearly not going to be happy about. But it's a question of whether that's still consistent with the settlor's intent. So take a look at that. Second is reviewing existing irrevocable trusts. We've created a lot of trusts for our clients over the years, and sometimes you run into a trust that was created years ago for the benefit of an individual, and it was structured so that it's not includable in the beneficiary's gross estate when they die. Well, now the beneficiary just acquired an extra $5.6 million roughly of estate and GST exemption. So the question is, should you be modifying that trust to cause inclusion of those assets in the beneficiary's gross estate to take advantage of their increased exemption? The reason that's important is because, one, you could have a generation skipping transfer tax imposed at the death of the beneficiary the way the trust is currently set up. However, if you modified that trust to cause inclusion in the beneficiary's gross estate, that GST tax could be avoided. The other benefit of the inclusion is that you get a basis adjustment for income tax purposes. So if you have highly appreciated assets in the trust, if you modify the trust to cause inclusion, then those assets are going to get a step up in basis for income tax purposes. Whereas if you left the trust as is, then you are not going to get a basis adjustment. There's an example on page 64 that kind of walks you through how you can utilize this type of planning to save millions of dollars in tax. But the one thing to keep in mind, the sunset at the end of 2025, where this really comes in handy, is if you have aging beneficiaries or beneficiary with a health issue that you're pretty confident they're not going to survive past 2025. Third, consider converting grantor trusts to non-grantor trusts. So like I mentioned before, we did create trusts for a lot of taxpayers that are grantor trusts. And what that does is it means the assets in the trust are not responsible for the payment of income tax, so they essentially grow a lot faster. The grantor, however, is usually somebody that's subject to estate tax because they have enough assets. And if they've been paying the income tax on that to reduce their taxable estate, the question is, are they still in a taxable estate situation? Or has the extra $5.6 million of exemption just taken them out of the estate tax altogether? So what you can do is essentially turn off the grantor trust status so that the grantor no longer spends down their now non-taxable assets on the payment of income. They may decide, you know what, I don't need to spend down my assets anymore. I'm going to go ahead and let the trust pick up the tax liability. If we get to the end of 2025 and it looks like the exemptions are going to be extended or increased even more, then you could always turn back on the grantor trust status in most situations. Fourth, this one is a big one for those of you that handle estate administrations and the administrations of revocable trusts after an individual's death. Basically, you have the option for decedents in 2017 to make an election to be taxed for income tax purposes on a fiscal year. And that fiscal year can be any length of time as long as it ends on the last day of a calendar month, and it's shorter than 12 months or shorter. The situation here is that the new tax rules and rates only apply to tax years beginning after December 31st, 2017. So you could have a decedent that's died November of 2017. If you make an election to have a fiscal year end December 31st, 2017, that means your estate beginning January 1st is going to start being taxed on its income at the reduced rates, the top rate of 37%. It also means, however, your miscellaneous itemized deductions have gone away. On the other hand, if you elected to make a fiscal year election to terminate the first tax year at November 30th, 2017, then all your income from December 1st, 2017 through November 30th, 2018 is taxed under the old rules. So you got to run that analysis and see whether it's more beneficial to be taxed under the new rules or the old rules based on the current situation. Moving irrevocable trust to Florida to avoid state income tax. So David mentioned there's a $10,000 limit now on the deduction for state income tax. That means it probably just got more expensive to administer your New York or your California trust. What you want to do here is consider moving that trust to Florida or another state that imposes no state income tax. A lot of times that's as easy as changing the beneficiary and changing the trustee and notifying the beneficiaries. Sometimes states require a little more formal procedure. But when you're doing that analysis, you got to consider where are the beneficiaries located. Because if the beneficiaries are in income tax states where they're going to be taxed on the income they received anyways, and the trust is going to distribute that income, then you're not really going to be saving much at the end of the day. However, if you have a trust that's accumulating income each year and it's going to pay the tax itself, then you avoid the state income tax, you avoid the limit on state income tax deduction as well. Lastly, one thing to keep in mind is that even though we have these higher transfer tax exemptions, that does not lessen the need for good planning. There's a lot of non-tax reasons that people should be planning or non-estate tax reasons, and a lot of times when we talk to our clients, these are the most important to them. They appreciate the tax benefits, but they are looking at things like asset protection planning, business succession planning, avoidance of family litigation, protection from spendthrift children, and of course, the ever-popular protection of assets from the heir's future ex-spouses. So keep those things in mind. Just because the exemptions have gone up, planning is not going away. It's just you may refocus your planning depending on your clients. So with that, I'll turn it over to Lauren.
Thank you, Brian. So I'm now going to talk about the impact of the new act on planning for married couples. So what do we do at death to provide for when the first spouse dies, to provide for the surviving spouse? And to do that, we have to start with understanding a concept called portability. And before portability came in, which became permanent in 2013, as you will recall, each individual had their own exemption amount, and if they didn't use it, you lost it. So if an individual did not take advantage of, when the first spouse died, all of their exemption, they could not pass it on to their surviving spouse. And so that was why a lot of the planning that we did for 100 years, literally, was to have assets owned in each individual spouse's name alone, and to create a trust when the first spouse died, called that bypass trust, that would take advantage of that exemption of the first spouse to die. Well, effective 2013, we have a new law called portability, and this allows for the surviving spouse to take advantage of the unused exemption of the first spouse to die. So if the first spouse dies and there's a $5 million exemption and they've only used $2 million of it, the excess $3 million can now be ported over to or transferred over to the surviving spouse, who can add it to their own exemption, and at that point then would have an $8+ million estate and gift tax exemption under the law before the exemptions doubled. And the unused exemption is known as the deceased spousal unused exclusion amount, or DSU amount. And so with this advent of portability, where a surviving spouse can elect to take the unused exemption of the spouse, it completely changed the way we looked at marital planning, estate planning for couples. And we can now truly look at the total exemption amount for both spouses in doing our planning. Before, it might have been very difficult to be able to take advantage of both exemptions, and now we can be pretty sure that we're going to be able to do that. The surviving spouse can use that DSU amount to make gifts during lifetime as well as at death. One of the really big important things is that the GST exemption, the generation skipping exemption, is not portable. I do not understand why Congress decided to make portability apply to just gift and estate tax and not generation skipping tax. I think it was just to continue to make planning difficult, but they did, and so we have to factor that in, and we're going to talk about that. And the DSU amount is not indexed for inflation, unlike the surviving spouse's exemption is. So now let's turn to planning. So in our outline, and in most commentators and planners' analysis, they look at what is the size of the estate and looking at what kind of approach you should take. And they'll say if the estate is less than the exemption amount for the spouses, for one spouse, or if it is between the exemption amount for one spouse and two spouses, or if it's over the exemption amount for both spouses, they put it in different categories as to the planning. I don't normally look at it that way. I normally look at it as what are the goals and objectives that we want to accomplish for this family. And if you look at what are the general goals and objectives that we want to accomplish for most families, we find that we have some tax things and we have some non-tax things. We have basically 2 tax considerations and 5 non-tax considerations. And then I look at the method that the 3 methods that we're going to talk about, and I apply the goals and objectives to these methods to determine what approach we might use, not just looking at what the amount of the estate is. So what are those goals and objectives? On the tax side, clearly we want to pay the least amount of transfer tax, estate, gift, and generation skipping tax. That may be the least important thing now going forward with these doubled exemptions, at least until 2026. And on the income tax side, we want to maximize that step up in basis. As you know, when somebody dies, the assets get a step up in basis to the value at date of death, wiping out all the gain up until that point. And that's the first step up in basis. But then there can be gain between when the first spouse dies and the second spouse dies. And we want to try and get a second step up in basis so that all of the assets will have a value now when the second spouse dies equal to the value at the date, and wipe out all that gain as well. So do these methods that we talk about take advantage of, for example, that second step up in basis? Then we have a lot of non-tax concerns. First and foremost, there was a survey done, and it was pretty clear that the most important thing to most people is that the estate plan that they want to have happen actually happens, a fulfillment of their estate plan. The assets go to whom and in the amount that the couple desires without chaos, family discord, or litigation. And that sounds simple, but as you'll see in a few minutes, that may not be so simple to achieve. And then we have protection from predators and creditors, I call them. If the surviving spouse remarries, can the assets be diverted away from the intended beneficiaries? If a beneficiary, such as a surviving spouse, becomes vulnerable to manipulation, even a family member, can the assets be diverted away from the intended beneficiaries? If a beneficiary has creditors, will the assets be protected and used for the benefit of the beneficiaries, or will they end up in the hands of the creditors? And if a beneficiary divorces, will the former spouse of the beneficiary be able to take the inherited assets as part of a divorce settlement? These issues are extremely important to most of our clients. The third one is flexibility. The laws are always changing. Will the plan be able to keep up with subsequent law changes and family circumstances? Brian, I'm going to let you do this. Obviously, I'm not keeping up with those. The family circumstances also change, and will the plan be able to change with those family circumstance change? The fourth concern is administration, hassle, and expense. How much expense and hassle will the plan incur? How difficult it is to understand? And the last one is there a benefit to somebody other than the surviving spouse during the surviving spouse's lifetime? Can descendants, such as maybe descendants from a prior marriage, have any benefit while the surviving spouse is alive, or do they have to wait until the second spouse dies? And so let's now look at the approaches and see how they match up with these goals and objectives. And so if we could go to the traditional approach, this is the thing that's been used forever and a day. This is where you have a bypass trust and usually a marital trust, Q-tip trust, or a spouse. And how it works is this is where you carve out an amount equal to the credit allowed to the first spouse's estate, put it in a bypass trust, and the beneficiaries of this bypass trust can be anybody that you want. It can be the children, it can be children from a prior marriage, it can be the surviving spouse. Generally, you give the trustee discretion to make distributions among the beneficiaries of this trust during the surviving spouse's lifetime. And then when the second spouse dies, the assets are distributed according to the direction of that first spouse. That's written down in the trust. And the assets of this bypass trust are included in the estate of the surviving spouse for tax purposes. Are not included in the estate of the surviving spouse for tax purposes. And the big benefit of that means that appreciation in assets between the death of the first spouse and the second spouse avoid the estate tax. So if we fund the credit trust with $5 million when the first spouse dies, and when the second spouse dies, it's now worth $9 million, that $4 million of appreciation is not subject to estate tax. That's the reason why these bypass trusts were used for, were the most commonly used thing in estate planning up until portability. Also, because the assets are not included in the surviving spouse's estate, there's no second step up in basis. Okay? So this method is great for estate tax minimization, not so good for income tax benefits. And then everything else over the credit amount goes to the surviving spouse, usually in a Q-tip trust. The assets that are in a Q-tip trust are included in the surviving spouse's estate for estate tax purposes. We have to pay estate tax on it, and because it's included, then we get a step up in basis, that second step up in basis. You can also actually use this traditional approach to apply and make sure that you take advantage of the generation skipping exemption by use of a reverse Q-tip election, which I'm not going to talk about. So the advantages and disadvantages. We get appreciation out, so it's good for estate tax. Although now these days, most of the planning we're concerned about is income tax planning. With these exemptions being so big, at least until 2026, income tax savings is generally what is going to be the most important tax thing on anybody's mind. And we've already seen that the bypass trust, we do not get that second step up in basis. So this is not so good for that. But now let's look at the non-tax issues. Because we use the bypass and the Q-tip option involves assets staying in trust, we have great protection from predators and creditors. Also, because things are in trust, the first spouse gets to direct where those assets go when the second spouse dies. So we have a high likelihood that the estate plan, according to what the first spouse wants, is going to actually happen. As to flexibility, this is very inflexible. There are trusts that are designated and specified, and if you want some flexibility, we can get that by adding in some more things like powers of appointment, trust protectors, giving a disinterested trustee the power to distribute trust assets for any purpose. We can add in some flexibility, but at its heart, it's pretty inflexible. And because this method can involve administering multiple trusts, it has more expense than some of the other approaches. However, this is an approach that does allow somebody other than the surviving spouse to have a benefit during the surviving spouse's lifetime. Let's look at the next approach. This is the simple approach. This is everything outright to the surviving spouse. How much simpler can that be? And through a combination of having assets owned in joint names, having the spouse named as the beneficiary of retirement plans, life insurance, and having a will or trust that says, I give everything to the surviving spouse, all the assets the couple owns ends up in the hands of the surviving spouse. And then, of course, you've got to make a portability election. This is why this portability is so important. You're able to make a portability election, which allows us to use that unused exemption, because when the first spouse dies, you give everything to the surviving spouse, you're going to completely waste the first spouse's estate tax exemption. So now that we have portability, we can make the election that we don't waste that exemption, and now the second spouse will have both exemptions of the husband and wife. All right, advantages and disadvantages, tax considerations. Everything's going to be included in the estate of the second spouse, so we don't get the benefit of having some assets, the appreciation on some assets be outside the estate, but with the increased exemptions, this may not be very important, okay? However, the portability election doesn't apply to generation skipping tax, right? So if we have a situation where we're interested in making sure that we maximize generation skipping tax exemption, this isn't going to do it. All the assets do get a step up in basis when the second spouse dies, so that's good from an income tax perspective. Now let's look quickly at the non-tax issues. This is really bad. This approach is not going to do a lot of what we want to do with achieving our non-tax objectives. The first one is that it affords absolutely no protection from predators or creditors, because all the assets are in the hands of the surviving spouse. If the spouse remarries, assets can be diverted to other beneficiaries. If the spouse has a car accident, all the assets can be taken by creditors. So there's no assurance that the assets are going to go the way the first spouse wanted. This is a really bad plan if you have a blended family. If you have children from a first marriage, okay, you do not want to use this type of plan. I have a friend who's a professor at Emory, very well-known, Jeff Pinnell, and he says the three greatest lies are: one, the check is in the mail; two, I'm from the government and I'm here to help you; and three, yes, honey, I will leave the assets to your children if you ask me to. Okay, and so you really cannot rely on the surviving spouse to implement the plan that the first spouse may want to have happen. It is, however, has very little administration expense because there's no trust, there's no ongoing requirements, but nobody can benefit from any of these assets until the second spouse dies, other than the surviving spouse. There is a variation on this plan that allows us to maybe have our cake and eat it too. And so when the first spouse dies, you take a look at the law and the circumstances that are there at that time, and maybe the surviving spouse says, wait a minute, I want some of those benefits of that bypass trust. I want the assets to be protected from creditors. Maybe I want to get some of that appreciation out. Maybe I want to have assets benefit somebody other than just the surviving spouse. Can we have our cake and eat it too? Well, if you build in something called a disclaimer option, yes, maybe you can. And this is where the surviving spouse disclaims some or even all of what they would otherwise inherit. And in the document, you provide for the assets to then go into that bypass trust. Okay, so the spouse can make a decision after the first spouse dies to maybe take advantage of that bypass trust if they want to do that. And if they do that, it would work, except that there are some problems with this, and that is that the decision must be made by the surviving spouse, who may not be capable or have the ability to do it, or maybe doesn't want to. If the spouse is insolvent, it's too late to do that planning because the disclaimer is not effective if the spouse is insolvent. And you have to do this decision pretty quickly. It has to be done 9 months after date of death, and the spouse can't have accepted any benefits from it, and such as using some of the money in the accounts. You've got to really hop on the decision to make that disclaimer pretty quickly. So let's go to the approach that is used most often now since portability came in, and this is leaving everything to a Q-tip trust. Okay? And don't have the bypass trust, don't have that, you don't carve out the amount that's free from tax. Instead, you leave everything in a Q-tip trust. That qualifies for a marital deduction. That means that all the assets are going to be in the surviving spouse's estate and will get that second step up in basis. You also make the portability election, so you can be sure that you are going to be able to take advantage of the first spouse's estate and gift or estate tax exemption. And you can even make something called a reverse Q-tip election that gives us the ability to take advantage of any unused generation skipping exemption. So the advantages and disadvantages are, excuse me, you can take advantage of all of the exemptions available to both spouses, but you don't get that appreciation out of the estate, and you get a second step up in basis. So it's not so bad on the tax front, and it's really good on the non-tax front because all the assets are in trust. So we're going to have protection from those creditors and the predators. The first spouse is going to direct where the assets go when the second spouse dies. So there's high likelihood that the estate plan that the first spouse wants is going to be fulfilled. And however, it's fairly inflexible unless you do some extra things like adding in powers of appointment, trust protectors, etc. And because there's usually only one trust going forward, it is not as expensive as when you have multiple trusts. There is one, I'm almost done, there is one variation on this plan that allows us to even make this plan better, and that is something that's called the Clayton Q-tip election. And this is after a famous case, the Clayton case. And here, again, when the first spouse dies, you can look at it and say, wait a minute, I don't necessarily want everything to be in the Q-tip. I want some of the advantages of that bypass trust. Maybe I want the appreciation to not be subject to estate tax. You can have your cake and eat it too here. You can make an election so that you make a partial Q-tip election and you move the assets out into a bypass trust. So the surviving spouse is not the one that makes this decision, however. Like with the disclaimer, it's all in the hands of the surviving spouse. Here, it is in the hands of a disinterested person, personal representative or trustee, who's going to make that decision. And one of the main reasons that people will want to do that is because it's a Q-tip trust. Only the spouse can have any benefit of these assets during the spouse's lifetime. And maybe they want other family members to have a benefit, so you can make this partial Q-tip election and move it into a bypass trust that benefits children, descendants, etc. And that is one of the reasons why people will do this. And so although the Tax Act doesn't have a lot of direct bearing on what we do, because the amounts have increased, it makes the need for looking at what we do when the first spouse dies and analyzing what's the proper approach even more important. And now I'm going to turn it over to Matt, who is going to talk about gift tax planning.
Thank you, Lauren, and thank you to everyone for sticking with us. I know it's been a very long morning, and we've dumped a lot of data on you this morning, and I promise we are coming down the home stretch here. My portion of the presentation concerns lifetime gifting after the Act, and essentially what that means is how do we make best use of those additional estate gift and generation skipping transfer tax exemptions that are scheduled to revert back to what they were before the Act at the end of 2025. But before I get there, I think what we need to acknowledge as advisors is that nearly all taxpayers will not need to make gifts in order to save on estate taxes. as I can put up on the slide. In 2015, when the exemption was a little more than $5 million, only 0.2% of all decedents were subject to the estate tax. In 2018, that's doubled, so very, very, very few people are going to have to worry about transfer taxes. Now, for those clients who have larger estates that are or could be subject to the estate tax, the decision whether or not to make gifts for tax reasons is complex and involves a consideration of a number of different factors, which I've shown some of them on the slide. But most importantly, what we want to pay attention to is basis planning, and Lauren mentioned this a little bit. When someone dies, we get to reset the basis of their assets to their fair market value as of the date of death. That eliminates inherent income tax liabilities associated with those assets. If we make a gift of those assets in order to save on estate taxes, with the estate tax rate currently at the 40% rate, we need to compare that to the income tax consequences when the donees receive a carryover basis and the inherent income tax liabilities associated with the assets they receive. This is not always an easy decision to make. For instance, there are certain taxpayers, maybe artists, for example, that have assets with a lot of ordinary income involved with a large portion of their estates. So careful consideration has to be given to not only the estate tax planning, but what are the income tax effects on the donees when we're looking at gifting. In addition to that, even with this careful analysis, planning is difficult because there's a lot of uncertainty about the future of the estate tax. There has been significant changes to the estate tax since 2001. Exemptions have increased dramatically, rates have been lowered significantly, and there appears to be a trend that may lead to the eventual repeal of the estate tax. However, the estate tax has been around for more than 100 years. 2016 was the 100-year anniversary of the modern estate tax. There were even a couple instances of temporary estate taxes in the 1800s when the government needed to raise funds. And despite efforts to repeal the estate tax since 2001, we largely have the same system today, just with increased exemptions and lower rates. So over the 100-year history of the estate tax, it's typically accounted for between 1 and 2% of federal revenues. And surprisingly, it seems to be an unpopular tax, even though it affects only around 0.1% of all decedents. So is there some impetus that could cause a resurgence of the estate tax or some other form of wealth tax to its historical norms, which would put it between 1 or 2% of federal revenues? Historically, the estate tax has been part of the solution to help the country's financial problems. So it may be helpful to take a quick look at the country's current fiscal situation. Our country's debt, as compared to its gross domestic product, is near record highs. The only time it's been higher was at the end of World War II. And you can see the CBO's projections going forward there is rather worrisome as it scales up quite dramatically. And that was before the passage of the Act, which is scheduled to add about $1.5 trillion of deficit. And if you weight it for growth, maybe $1.1 trillion. So the bottom line here is that I think we need to acknowledge that there is a possibility of a more robust wealth or transfer tax system sometime in the future. That depends on whether the government needs to increase revenues, and historically they have turned to the wealth transfer taxes as part of a solution to fiscal problems. However, we think that the current environment is extremely favorable for wealth transfer, and we see that continuing to persist, at least through the current administration, through 2020. We're going to look at a few techniques to use the additional transfer tax exemptions, but before we get there, a few remarks on the clawback, which Brian touched on at the beginning of the presentation. And essentially, this is taxing the use of exemption that the government takes away. And it has to do with how estate taxes are calculated. Estate taxes are not calculated by taking the decedent's gross estate and whatever exemption is remaining and coming up with a tax. Estate taxes are calculated by taking the decedent's gross estate, adding back in all prior gifts, then crediting with the exemption that's there at the date of death and crediting for prior gift taxes. Because we add back in all prior gifts and only credit for the exemption in effect at the date of death, there's a possibility that there's going to be a tax on the gift that was previously covered by exemption. So this is not an easy problem to solve, or they probably would have taken care of it in statute. Instead, they punted it, and we hopefully will get some regulations. But typically it takes a long time for the IRS and Treasury to issue regulations. The good news is that with the clawback issue, the donor is no worse off for having made the gift. Okay, there's no risk of making the gift. It's obviously worse off if the clawback applies, but you're no worse off for having made the gift. The only other point I would make about the clawback is it can create an inequity with respect to the tax, because the clawback would apply when somebody dies, and this could relate to some gift that was made to different beneficiaries. So if you're in a situation, you want to think about tax apportionment in your estate planning documents. And now we're going to go on and consider some tax planning techniques, and we're going to start with something that's simple but relatively effective use of exemptions, and that's just a straight gift to a dynasty trust. And we'll take a look at an example here. Here we have an individual with a $20 million estate. The estate's growing at 8%, and we have a table that shows the difference between gift and no gift in 2018 when death occurs in 2025. We're not going to walk through all the calculations here, just refer to the bottom of the table. You can see that the heirs benefit by $2.855 million when a gift is made in 2018 as opposed to no gift being made at all. And the difference there is attributable to the growth of the gift. So in this case, they made a $10 million gift. It grew by over $7.1 million. That $7.1 million is outside the estate tax system, 40% of that amount. That is the benefit to the heirs. When we're talking about use of credit, we're really talking about the growth of the assets in the hands of the donees as opposed to the growth of the assets in the hands of the donor. And we're going to skip on and take a look at the effect of the dynasty trust being a grantor trust for federal income tax purposes. And Brian touched on this at the beginning of our presentation. And a grantor trust is effectively treated as if it is owned by its grantor for federal income tax purposes. Your typical revocable trusts, or living trusts, if you will, are grantor trusts, and we ignore those for federal income tax purposes. But we can also have irrevocable trusts that are designed to be grantor trusts that are owned for federal income tax purposes, but they are not considered owned for federal estate tax purposes. The assets are excluded from the donor's estate. And what happens when you have a grantor trust is that the grantor has to pay the income tax on the grantor trust's income. This is the legal obligation of the grantor. It is not considered a gift by the grantor. And I think a lot of people underestimate the benefits of the payment of the income taxes so that the grantor trust can grow income tax free. And we have an example to illustrate this point. Same facts, $10 million estate. We've made a gift in 2018. And we've just taken a conservative 30% flat rate for the income taxes. And so the table at the bottom, again, we're not going to go through all the calculations here, but you can see that we've added another $1.36 million of benefit to the heirs by the grantor paying the income taxes on the grantor trust's income. This is essentially attributable to, we've calculated $3.4 million of federal income taxes. That's paid by the grantor, and the benefit of that is removing it from the estate, allowing that grantor trust to grow tax-free. Next, we're going to move on to one of our favorite planning techniques, and this is the installment sale to a grantor trust. This particular technique is particularly useful when we want to leverage the donor's estate tax exemption, and also when the donor wants to, say, retain a stream of payments associated with the asset they're going to sell. At the heart of the installment sale to a grantor trust is basically just providing a very good deal to the purchaser of the assets. Not such a good deal that we create a gift tax, but nevertheless a very, very good deal. So let's take a look at the transaction here. We have a revocable trust selling assets to a dynasty trust. Those are both grantor trusts for federal income tax purposes, so they will be ignored for federal income tax purposes. That means that there will be no gain recognized on the sale of the assets. There will be no ordinary income on the interest payments of the note in exchange for those assets. And in our opinion, the purchaser will take a carryover basis in the assets that are purchased. So in our case here, the illustration, we've had a seed gift of money of $11 million to this dynasty trust. We want to make a gift, and a rule of thumb for this transaction is we want to put 10% of the amount that we're going to purchase into the dynasty trust. The dynasty trust has to have some substance to it in order to enter into the sale transaction. So we're going to seed it with $11 million. Then we're going to sell a 60% limited partnership interest worth $111 million, and you can see how much now we've leveraged up the exemption here to the dynasty trust in exchange for a promissory note of $111 million. If you look down at the bottom left of the chart, a couple of corrections. First of all, there's a purchase price of an LP interest, not stock. But more importantly, the net asset value really should read a little over $308 million, and the undiscounted value is $185 million. So as Brian mentioned, a couple of years ago, everyone was very worried that valuation discounts were going to be taken off the table. Those proposed regulations under the special valuation rules were removed last year, so valuation planning is still alive and well. And you can see an undiscounted value of $185 million, which is not marketable, and there's no control with that interest, can be discounted. In this case, the illustration is by 40%. So we get it down to $111 million in the sale, whereas perhaps the buyer and seller really view that as a $185 million asset. The idea here is that the distributions on the limited partnership interest will be used to make payments on the note. And so cash flow is key in setting up these kind of transactions. And you can see that we've calculated here, we've done a 9-year interest-only note We do interest-only note because this provides the most flexibilities. We can allow for prepayments to be made, but we're at the minimum amount of payments that are required to be made each year, and we have a balloon payment due at the end of that 9-year period. And you can see when we have the current very low-rate environments, we've got a $2.4 million annual payment on that, but understand that is only less than 1.5% of the undiscounted value of the assets that we've sold. So presumably we'll have the cash flow there to be able to at least cover the interest and hopefully pay down the note over time and make that balloon payment at the end of the period. The net effect of this here is that we haven't reduced the estate by $111 million. We really exchanged assets. We've put an asset that we think is going to grow more than the current applicable federal rate, which is a little over 2% in this instance. And we're going to use the cash flow generated by that asset to pay down, and perhaps the donor will consume the payments coming back or do some other planning techniques to further reduce the estate. The last thing I'm going to talk about here today, and I'll go over this very quickly, is a spousal lifetime access trust. We did quite a few of these in 2012 when the exemption was scheduled to go from $5 million to $1 million. And essentially, this is a lifetime credit shelter trust. So commonly, we would see these trusts created when somebody dies. We would divide the estate into a marital share and a credit shelter share, the idea being that the surviving spouse would have access to the funds for the surviving spouse's lifetime, and it would be excluded from the estate of the surviving spouse. And it would get to grow and appreciate during that time period, the surviving spouse's lifetime. So here what we've done, we just create a credit shelter trust during the lifetime of the spouses. And each spouse is going to create a credit shelter trust for the other spouse, and they're going to use the remaining exemption. So we get the growth of all the exemption to escape transfer taxes. We can include the descendants as beneficiaries of these trusts. We can allocate generation skipping exemption to these trusts so they can pass down generations free of estate tax. Each of these trusts will be grantor trusts as to their donor, so we can further enhance the appreciation by paying the income taxes on these trusts. Now, there is a caution here. We have, say, divided the estate into 2 shares, and when one spouse dies, we're going to lose access to that spouse's credit shelter trust. And if that's an important consideration, then we might be able to use life insurance to sort of augment the survivor's estate to cover for that. The most important consideration that we have with the spousal lifetime access trust is a judicial doctrine. It's called the reciprocal trust doctrine. And what happens, or potentially could happen with the reciprocal trust doctrine, is that the trusts are uncrossed. So if the trusts are the same terms and the same trustees, created at the same time with similar assets, the government could come in and say, no, it's just like you created the trust for yourself, so we're going to pull it back into your estate for tax purposes. So we avoid the reciprocal trust doctrine in a number of different ways, which I've listed up there. We create them at different times, fund with different assets. We have different distribution standards, maybe different trustees. We just make them as different as we can, so we can avoid that judicial doctrine that would allow the government to come back in and uncross those particular trusts. And in closing, I would just like to say that the transfer tax system is essentially the same that we've been dealing with for many, many years. We have a full toolbox full of techniques that we can use for transfer tax planning. And as I said at the beginning, the current environment has never been better for wealth transfer. We still have very, very low rates, which you could see with the installment sale, how effective that can be. And with that, I'll turn it back to Lauren.
I was just going to do a very, very quick summary of 4 takeaways, I think, from our presentation. And that is, one, I think we need to pay closer attention maybe than we have in the past to income tax considerations in our estates and trusts, and work with your accountants and professionals about making distributions from trusts to minimize taxes and the timing of those distributions, particularly during this transition period. Two, we need to look at documents that have formula clauses, because we may need to make some changes in those documents. Three, gifts are still things that we should be considering, but you need to be aware of the loss of the step-up in basis if you are making gifts of something other than cash. And four, grantor trusts are still a fabulous thing to do, and particular emphasis on the spousal limited asset trust. This is a way to use this exemption before 2026, so you can be sure that you're going to take advantage of it, but still have retain the benefit between the spouses. And with that, I would open it up. If anybody has any questions, we're happy to answer a few. I know you're exhausted. 3 hours is a long time. But if you had any questions, you can ask us or come up afterwards. Any questions? You're tired.
All right. Thank you all for coming.